Hey, it's Tyrone Jackson, the wealthy investor here, and let's get right into this lesson, which is about how to make money when stocks decline using spreads. Now, everyone thinks they're a genius when the market is actually rising. Why? Because all you're doing is trading a stock, the institutional money is driving the stock higher, right? But that doesn't make you a genius at trading. The real fast, sexy money comes, believe it or not, when stocks are dropping. When the market is reacting to something that's really negative, there's a tremendous profit opportunity if you know how to use spreads at lower risk. So I'm going to dive into this lesson. I'm going to use a stock that's a member of the S&P 500. Why? In the Wealthy Investor Program, we try not to take big risks on things like penny stocks, right? We want stocks with established reputation. Now, let me just introduce a couple of elements to you because no matter what level of trading you're at, if you're one of those people that, like me, is a covered call writer first, right, or you're learning how to write covered calls, the question is, do you know how to use spreads on what? S&P components. Why? They are widely held and there's a lot of institutional money here. So let's just start off with some very wealthy investor basics. Look at the 5-year chart here. You'll notice that 5 years ago you could have purchased Starbucks shares at $36. Stock is on its way to doubling here, which is a typical wealthy investor pattern, and it's currently trading at 63.62. I also want you to look down here at the 52-week range. You see that the stock has gone from 47.37 to 68.98. Well, this 68.98 is telling me that this stock is close to its 52-week high, right? Why do we want to trade stocks that are always close to their 52-week high? Because that's where the institutional money is. That's where the big boys are. We know that this stock is also fascinating. Why? Because it also pays a dividend. In this case, the dividend is $1.44. Great. Strongwood upward trending stock pays the dividends. The earnings are there. I'll let you do that research on your own. Now, I always teach you to look at pictures first, right? So if we look at a picture of Starbucks and we look at the 5-year trend, notice that even though the stock is trending higher, you see all these things that look like Swiss Alp mountains. These are peaks and valleys, and this is what volatility actually looks like. So notice the stock runs up here off the bottom from 52, and it runs up very quickly to 62, then it rides, and then it pulls back down to 54, then it peaks again, and it pulls back. Notice here it's in a strong downtrend, boom, uptrend, but notice how quickly it sells off here from 64 down to 53. That is quite a drop. We also see a significant drop here. Again, looking at the 5-year chart from 57 all the way down to 48. Now let's just stop because I always like to try to make things as simple for you as possible. When the stock started dropping from 56 all the way down to 48, there was money to be made on this decline. When the stock starts to rise again, we call that retracement and then a pullback. So this is a longer picture. It's a 5-year chart. Look at the last 6 months. We see a run up here and then this pullback and the stock starts to decline. So all of a sudden, if you bought the stock at, let's say, 68 and it starts to decline, if you only know how to make money when stocks go up, meaning the stock market is bullish, you're missing all this profit on the way down. If you zoom in even closer, you see that how pronounced that decline is, right? When the stock even goes from 66 and it slams all the way down to 60. This slam down is where profits are, but it's really only the most educated investors that know how to do that. So what I'm going to show you now, let's go back to the homepage of Starbucks at 63.62. If the stock is rising, I am a what? I am a covered call writer. I'm looking to buy the stock at 63.62 and sell it at a higher price. So let's assume, for argument's sake, we're in the month of January, right? And I want to trade these shares and get paid guaranteed money on the sale of the stock, then I am going to be a covered call writer. Now, many of you know this because you always post and say, hey, I love making money with covered calls. Stock is at 63.62. I'm going to go out to February. Look at the 65 strike right here in the month of February. I'm going to take in $1.54 per share. If I were doing that with 1,000 shares, I'd take in $1,540 guaranteed. How do I know that? Because that's what the market is telling me the rights are going for, to have the stock bought away from me at $65. Again, market is rising. I want to make a quick $1,500. I'm going to sell a covered call at the 65 strike. Now, what does that actually look like above and beyond just looking at pictures like this, right? And trends in the stock? Well, it actually looks something like this. How to trade stocks in up and down markets. So step one, this is what it looks like written out, what we just did. I'm going to purchase 1,000 shares of Starbucks at 63.62. I'm going to sell, for those of you who know, an out of the money covered call at the 65 strike, less than 30 days out. At the 65 strike, I'm going to take in $1.54. That means I am making guaranteed income, totally 100% guaranteed, $1,540. How long does this covered call take? 2 or 3 minutes when you get really good. For those of you who know, I'm just doing a little review. That means you're getting your money, this $1,540, in T plus 1. Trading day. Place the trade today, the $1,500 shows up tomorrow. If the stock is actually brought away from me at the 65 strike, I'm going to make another $1.68 per share. I love this. This is my primary trade. That means in less than 30 days, I'm going to make an additional $1,680 in income. If you don't know about cover calls, this is the magic of cover calls, right? I'm only trading a couple of times, but look at the money. Look at the money I'm actually bringing in. 1540, $1,540 for selling the call, $1,600 if the stock is actually brought away from me. Again, when the stock is rising, another way to express that is when the stock is actually bullish, what am I doing? I am selling cover calls into the uptrend as the stock is rising. What happens when the stock starts declining? Or it works for any stock, but we're going to keep with Starbucks here. Stocks are dropping. One of the ways that you can make fast, sexy money is learning how to set up a spread. Now, let me explain this to you in terms that'll make it a little bit easier. You see, I'm willing to buy the stock when the market is going down, but I only want to do it when the stock rises. To take advantage of the decline in the stock, I'm going to set up a spread. Now, what is a spread? A spread is buying one, in this case, call option. You see this in step 2, that is out of the money. And then I'm going to sell a call option against the call option that I purchased. Now, a lot of people initially have a hard time with this trade, but once, like anything else, you get used to it, it's very profitable. So, without owning the stock, I'm going to buy an out of the money call option, and I'm going to sell another out of the money call option against it. And I'm not going to put up a lot of money to get an astonishing rate of return. In this particular example, OTM means out of the money call. I'm going to buy a contract for $10, and then I'm going to sell another contract against that contract for $100. You see, when I buy one out of the money call, I'm only putting up $10, and then I'm selling another out of the money call against it to take in $100. Well, if you subtract from the $100 the $10 I put up, I'm making $90 for every 100 shares, or $90 per contract. So therefore, if I buy 10 contracts and which only cost me X amount, and I sell my 10 contracts for $100, that's $1,000, I net $900 guaranteed while the stock is dropping, and I don't even own it. I mean, is that crazy? Is that amazing to make money without owning the stock when the stock is dropping? When would I set up a spread? When Starbucks is in one of these downward trends, I want to capitalize on the downward trend by setting up a spread. When the stock starts to rise, I want to own it and I want to sell cover calls. Do you see a pattern here? When stocks drop, we set up spreads. When stocks are rising, we covered call right. When you get good at setting up covered calls and spreads, market direction doesn't matter to you, because no matter where the stock is, a stock like Starbucks, you're always making money. Sometimes you own the shares, sometimes you don't. Now, I'm always talking about your wealth in your thinking, right? The reason that my students make so much money and do so well over time is when they learn to master both sides of the trade. Cover calls when stocks are rising and spreads when stocks are dropping. Have you ever owned a stock that seemed to just keep dropping? Right, you could have gotten paid if you understood the magic of spreads. And this is why I'm always saying to you, your wealth is in your thinking. But to capitalize on today's market, you need to have a financial education that allows you to make money in the stock market even when stocks are dropping. Now, I don't know about you, that is really exciting. Why? Because a stock like Starbucks can only do one of three things: go up, go down, or stay the same. Go up, go down, or stay the same. And if we look at the 5 year pattern, the stock has stayed the same on some days, dropped, risen, dropped again, risen, peaked, dropped, and the same pattern repeating itself over and over and over and over. So, to capitalize on cover calls and spreads, what do you need? Another financial education. But your goal, wherever you are right now, is to learn how to make money regardless of the direction of the stock. So, and bear and down markets, we set up spreads that are called bear call spreads. Why? Because on Wall Street, bears represent retreat, bulls represent aggression. Okay? So, hey, Tyrone, what are the advantages of setting up spreads? The answer is you don't have to own the stock initially. You just can take in the money on the spread as the stock is going down. Now, I'm going to offer you a fantastic opportunity. If you want to learn more about spreads and use the wealthy investor approach, all you have to do is go to thewealthyinvestor.net/bear market. That's thewealthyinvestor.net/bear market. My webinar is just a few days away. Just come to the webinar. I'm going to show you on stock after stock after stock after stock how to set up bear call spreads and use cover calls. Okay? So now is the opportunity to really change your life if you have money in the stock market, or you just want to find out how all these $1 million traders actually make money when the market is dropping. And I realize for a lot of people that is big news, that there's money to be made when stocks actually drop. And the answer to that is yes. So all I need you to do right now is head on over to thewealthyinvestor.net/what? Bear market, and join me on the next live webinar so that I can explain to you how to make money when stocks decline. And with that, I will see you at my next live webinar.